Hello there. I really hope you guys are enjoying this because I am. This is the third part of the monetary sector. In the first part, remember we spoke about money. If you haven't checked the video out, check it out. We discussed what money is, where money came from, where money is now. After that, in the second part, we spoke about financial intermediaries and the role of the central bank. We discussed a bit the functions and monetary policy as well. But I promise that I'm going to talk about monetary policy again in this video. So the third part talks about the demand for money, which is rooted on a theory by John Maynard Keynes, the Liquidity Preference Theory. Keynes is a very fascinating economist, which I'm sure you guys are going to come to love at this level. Very soon, you'll be talking about Keynesian theorems a lot. Interesting stuff. It will get your mind thinking. Anyway, let's get into this last section where we talk about the demand for money. Demand for money. The demand for money basically talks about the reasons why people hold money. Why do you want money in your pocket? Why do you want money in your bank account that you have immediate access to? Okay, and this demand for money can also be referred to, because remember, when you have money, you are said to be liquid, money that you have access to. This can also be referred to as liquidity preference. The amount of money you want to hold, or the amount of money you want to hoard, a liquidity preference. All right, it's liquidity preference. Why do people hold money? What are the reasons that you would hold money? Number one, people hold money for transaction purposes. You want to keep money in your wallet because you want to transact. You want to keep money in your bank account so that you can swipe it any time because you want to buy goods and services. You want to transact. The second reason people hold money is because they might face an emergency. So this is referred to as the precautionary motive. So number one, there's the transaction motive. Number two, there's the precautionary motive. The precautionary motive is just in case, or for emergency. When there's an emergency, you have access to your money. That's the precautionary motive for holding money. So these are the two main reasons why people might keep money in their bank account. They want to transact. You want to buy water now. You want to buy a pie. You are hungry. You want to buy something. You want to travel, and usually to pay money, to pay for your taxi, you need to pay your taxi fare in cash. So to transact, people keep money, and just in case something happens, for emergency, you also keep money. These two reasons for holding money are referred to as these are actually active money balances. These are active money balances. The reason why we say they're active, it's money that you keep knowing that you are going to use it immediately or in the near future, which is why we are saying it's active. This amount of money, these active money balances, are dependent on the amount of income that you have. Think about it. I don't know your financial status now, but if you are a poor person, chances are you probably have like 100 Rand in your wallet to pay for the taxi, or less, or you can have like $10 in your wallet to just pay for your transport or buy a cupcake and a cup of coffee, right? But do you think Elon Musk would have the same amount of money? No. Elon Musk might have like 3,000 in his wallet, US dollars. Or Cyril Ramaphosa might have 20,000 rands in his car, which is nothing. Maybe I remember Pala, the guy was found with how many millions? I don't remember the figure, but it was a lot of money that was found in his house for whatever reason. So the amount of income is going to determine the active money balances that people have. Money that you have for transactions and for precautionary reasons. The money you keep is strongly determined by your income, the level of income. We use Y to represent income. So the money for transactions and for precautionary motives, the active money balances, do not depend on interest rates. They have nothing to do with interest rates. The money you have in your wallet now, you put it in your wallet, you didn't even look at what the interest rate is. You just put it in your wallet because you want to transact. You want to do certain things. So that's it's independent of interest rate. So regardless of the level of interest rate, the amount of money, I'm going to call this money quantity of money. Let me call it L, quantity of money, or the liquidity preference. You can use L or Q. It's up to you. It doesn't matter. Liquidity preference. Regardless of interest rate, the money demand is going to be the same. So this is the money demand for active balances. This is active money. This is money for transactions and money just in case for precautionary reasons. Okay, it's independent regardless of interest rates, whether your interest rate is 1% or your interest rate is very high, it's 50%, which is a lot. You don't care. You're going to hold the same amount of money, so your liquidity preference doesn't change. It does not depend on interest rates. It's independent of interest rate, right? So those are two reasons why people hold money, active money. The third reason why people hold money is called the speculative motive. So this is the reason number 3, why people hold money, why people demand money. It's called the speculative motive. So this speculative motive is dependent on the interest rate now. People are speculating on the financial markets and looking at how much money they would make. They consider interest rates high to be the opportunity cost of holding money. They consider interest rate to be the opportunity cost of holding money. Remember, opportunity cost is the value of the foregone best alternative. What this means is, when interest rates are high, are you going to keep a lot of money or you're going to keep less? At high interest rates, if you keep your money in your pocket or under your mattress, the opportunity cost is too high. You're losing out. You could be making money from these interest rates. So people are going to demand less money. So the money demanded when interest rates are high is low. People don't keep money. They don't hold money. They invest that money so that they can take advantage of high interest rates. The opportunity cost of holding money is too high when interest rates are high. Hence, the money people keep is low. But when interest rates are low, there are no returns here. Opportunity cost is quite low. So people would rather hold on to their money and use it to transact or just in case. Hence, you see the speculative demand for money is also referred to as the passive money balance. It's passive money. It's money that people are keeping in financial markets. But this is dependent strongly on the interest rates, which means that if this is your interest rate, this is your demand for money, the liquidity preference. Like I said here, when the interest rate are high here, high interest rate, the demand for money is going to be quite low. They're going to demand here. So it's low here, low demand. But when the interest rate are low, the demand for money is going to be high. People would rather keep their money than invest at low interest because they're not making any money. When you join these two, you have your money demand curve. So this is your money demand curve or your liquidity preference curve. For passive money balances, they are dependent on the interest rates, which we said is the opportunity cost of holding money. All right. So you have the interest rate, you have the active money, which is based on the transaction motive, and precautionary motive. Motive. We said these give you the active money balance, and it is independent of interest rates. It's like this. It's independent of interest rates. This is the money demand, and the passive money balance is based on interest rates. So this is the speculative motive. Speculative motive, the money balance is passive. At high interest rates, the demand for money is low. And for low interest rates, the money demand is high. It's like this. If you add these two, they should give you the money demand curve. The total money demand curve is a summation of these two, and it's just a downward sloping demand curve. So money demand slopes downwards. This is liquidity L. If it's confusing you, just use quantity of money. Doesn't matter. It's going to be downward sloping like this. So this is the money demand curve, which is the summation of the money demand curve, which is the summation of the passive money balances and the active money balances. The passive money, which is the speculative motive, and the active, which is the transaction and precautionary. Right. Now, what we are going to do in this, for purposes of our analysis of monetary policy, we are going to consider, we are going to assume that the supply of money is exogenous. When we say money supply is exogenous, we are saying we take the value of money in the economy as a given. The central bank just prints and puts money in the economy. Nothing else determines the money. We take the value as given. That's exogenous. Hence, it's independent of the interest rate. The money supply is going to be like this. This is money supply. And remember, if it's vertical like this, it's exogenous. This exogenous money supply, we take it as given. When the money supply meets the money demand is the equilibrium. And so this is the equilibrium interest rate in the money market. Right. Now, the money demand is going to be affected by things like income. Remember, the transaction motive and precautionary motives for holding money are affected by income. If there is an increase in income, for instance, if the income, I use Y for income, if there's an increase in income, the money demand is going to shift to the right like this. There's a shift to the right of the money demand, which increases interest rates, right? It increases interest rates, but the money supply is not affected because remember, the money supply is given by the central bank. All right, this is an example of an increase in income, increasing money demand, and ultimately increasing the equilibrium interest rates in the money market. This graph shows the money market equilibrium. I'm going to conclude this by talking about monetary policy, right? I'm going to do it in two parts. In this, at this side, let's talk about expansionary monetary policy. Expansionary monetary policy. And on this side, let's talk about contractionary monetary policy. Contractionary monetary policy. Remember, expansionary is the loose and the contractionary is the strict monetary policy. Expansionary monetary policy can take the form of, for instance, a decrease in the repo rate. The repo rate, remember, it's the accommodation policy of the Reserve Bank, where to meet their reserve requirement, banks borrow from the central bank and they are charged this repo rate. It's a decrease in the repo rate, or this decrease in repo rate increases the money supply. Okay. Alternatively, the central bank can reduce the cash reserve requirement. This is the money mandated by the Reserve Bank, the percentage that they must keep in their reserves or in their account with the Reserve Bank. If they reduce this, it's an expansionary monetary policy, or they're going to, the central bank is going to buy financial assets on the open market. So they buy bonds. By buying, they're injecting money in the economy. So they buy on open market, and this increases the money supply. So when you draw this, you're going to have your interest rates here, your liquidity or quantity of money here, money supply here, money demand here. You see, if all of this increases money supply, it means the money supply curve is going to shift to the right like this. Money supply. Hence, you see the interest rate is going to go down from here. The interest rate is going to fall to here. So this is expansionary monetary policy, and I've given you a few examples here. Contractionary monetary policy is the opposite now. they want to remember, expansionary monetary policy, the whole idea, eventually, this reduction in interest rates must eventually lead to an increase in GDP. So to increase GDP when an economy is going through a recession, they use the expansionary policy. However, the contractionary is used to deal with inflation, and they can do this by doing the opposite of this, either by increasing the repo rate, decreasing money supply, increasing the cash reserve requirement, which means they have fewer dollars or rands to give out as loans, or they can sell. If the central bank is selling assets on the open market, so if they sell, they are taking money, they're giving paper to the market, and they're getting money from the market. So they are taking money out of circulation. This reduces money supply. Hence, your money supply curve is going to shift in the opposite direction. You have your money supply, which looks like this, your money demand, which looks like this. This is the quantity of money. This is the interest rate. The money supply shifts in this direction, and this, you see, it pushes the equilibrium interest rates up. So interest rates are going to increase. All right. So this is the contractionary monetary policy. I hope this makes sense. Drop a comment. Let me know what you'd want me to do. If you have questions you want me to address, send them to me in my next videos. I'm going to do 1 or 2 videos to address questions on the money market. Not just money market, but the monetary sector in general, from everything. What is money? What is the central bank? What does it do? Monetary policy, the liquidity preference theory. In the meantime, enjoy economics. Mr. Mesh out.